Good afternoon. You are welcome to my channel once again. This is the continuation of the first video that was done some minutes ago. So you are welcome back. This is the last section of this analysis of final account, which is according to the list of topics that I've given to you in the previous video. Now, I want to give you analysis of thorough analysis of balance sheet. Now, balance sheet that you are seeing that is written there on the board. Another name for balance sheet is statement of financial position. Statement of financial position. But for secondary school level, we still call it balance sheet for them to understand that this balance sheet, for them to really understand balance sheet. Now, this is called statement of financial position because it is not an account but a statement. And if you look at the heading, it says balance sheet as at 31/12. So balance sheet as at. The reason for using as at is because balance sheet can be prepared as at any day, as at any date. Balance sheet can be prepared as at any date. It is not proposed that we have to wait till ending of the year or ending of financial year before preparation or before preparing this balance sheet. Balance sheet can be prepared as at any date. That is why this balance sheet is using this heading balance sheet as at 31/12, depending on your financial month end or year end. Now, if you look at the balance sheet that is written on the board here, it has different sections. It has 5 sections. It has section at my left hand side. We have the capital section and also long-term liability section and current liability section. And at the right hand side there, you can see it has fixed assets section and current assets section. As I said the other time, this balance sheet is a statement and it is not an account. That's why it does not have debit side, no credit side. Compared to the other two accounts that I treated some minutes ago. This does not have the debit side, not have the credit side. So let me enter into this balance sheet and I'll give you the analysis of this balance sheet. So let me start with the capital aspect since this section is more closer to me. So we can see the another side that is written there, this depends on the currency that the question is using or that has been used in the question or the currency that the company is using. But it doesn't matter whether you are using two currency, maybe two naira sign or single naira sign, but depends on you or whoever is doing this. Now, there used to be we to have capital in the trial balance. That capital in trial balance used to represent the opening capital. That is the capital before the operation for that year, before the operation begins that year. Then profits generated during the year must be added to the capital that was given in the trial balance. So which we increase the capital to this if there is profit during the year. But if there is a loss, if a loss was as it was generated, then it must be subtracted from the capital. But most often there used to be profit and it must be added to the capital, which is the capital as given in the trial balance. Then it will increase to this. Then we have to less drawing. Less drawing. Drawing is indirectly reducing the net worth of the business. It's indirectly reducing the net worth of the owner of the business. So when we remove the drawing, then we're going to have close capital at the end of the year we're looking at. Then let me come to long-term liabilities. Long-term liabilities. These are obligations that the company must fulfill within in a period that is more than 1 year, 2 years, 5 years, 10 years. There are long-term liabilities are obligations that the company must fulfill. So I have examples there: loan and debenture. So remember, long-term liabilities are debenture obligations that a company intend to fulfill after 2 years. Then let's look at current liability. Current liabilities also are obligations that the company or the company must or the company is planning to fulfill within 1 year. That is within the next 12 months. Within the next 12 months, the company is planning to fulfill all this. So there is a difference between long-term liabilities and current liabilities. Long liabilities are obligations that the company is planning to fulfill, debt that must be repaid after 1 year, after 1 year, 2 years, 3 years, up to 10 years. While current liabilities are obligations that the company is planning to pay to fulfill within the next 12 months. You have examples there, creditors of current liabilities, you have bills payable, you have expenses accrued, expenses accrued. Well, expenses accrued. Accrued simply means when the company has enjoyed the service and the company has not yet paid up for that service. So the amount that the company is still owing, that the company has not paid for, is being referred to as accrued. Now, let me also talk about fees, the other section, the other side of this balance sheet, the right hand side of this balance sheet, which is this is another section, fees assets section. Fees assets represent properties of the company, properties of the company, the their assets, their properties of the company that the company can see, can touch, can feel, and they're going to be functioning or they're going to be used by the company for more than 1 year, like 2, 5, 10, 50 years and above. So all these assets, these assets are items that properties of the company that will be serving the company, that the company will be using for many years to come. And inside this section you can see there used to be cost, which is amount that we bought all these assets. Then there used to be yearly depreciation, which must be subtracted from the cost to arrive at NBV, which is net book value. Net book value, which is accounting valuation, accounting value, which is also accounting value. Now, we have more fixed assets, but I decided just to write only two, just for us to know the structure, for us to master the structure. Also, we also have current assets. Current assets, current assets are properties of the business also, or they are properties that the company is planning to or the company that converts into cash within 1 year. That is within the next 1 year or within the next 12 months. The company can convert them to cash within the next 12 months. So they are just available in the company just for 12 months. So examples, we have closing stock. The closing stock which was not used this year, then we will transfer to next year. We also have debtors. Debtors, then we have to subtract provision for bad debts from debtors in order to be able to ascertain our actual net debtors. Then we also have prepayment. Prepayment means when you are paying ahead for services that has not been rendered for you at all. If you are paying ahead, you are still in this year, this 2024, and you now you decided to pay for next year. So that is prepayment. So which must be treated as still part of something that belongs to the company. So we also have bank and cash. So this is the structure of balance sheet. As I said, balance sheet is not an accounting statement. Remember that this. And another name for balance sheet is statement of financial position. So this is the structure which must be mastered, and it is very simple. And we are going to be using this structure as time goes on. As time goes on. So please look forward for the next video, which is going to be about the next topic according to the topics listed in the list of uh, items given in the previous videos. Don't forget to subscribe. Don't forget to like and share with your friends. And also watch out for the next video as the videos will be rolling out one after the other. And the university, for university, those in the university, the topics the topic as listed in the list of topics also will start coming up from this video also. So please stay tuned and watch out. Thank you.